panel, Rebecca Walser of Walser Wealth Management and David Bahnsen, founder of the Bahnsen Group. You know, Rebecca, it changes almost daily, but the tide is turning. And if you thought the Fed was done, it looks like maybe they're not.
Absolutely, Charles. And I said that so long ago. I said, hey, if you think that we're going to get a pause and then a pivot, you know, because everyone was talking about pivot a couple months back and the market was pricing it in and really expecting and having going on a tear. And it just wasn't going to happen. The labor market was just, for the small and medium-sized businesses, just too tight. And it's going to just keep giving the Fed too much trouble on tight labor conditions. And obviously, if you have tight labor conditions, wages go up, have gone up, and there's a lot of openings and they can't get filled. And so we have that situation happening.
You know, David, my concern, though, looking at that last jobs report, is that wages are going up, but they're going up slower. We learned from the small business NFIB that they're done. They're not going to spend much more on CapEx or hiring. And you got to be concerned about the so-called lag effect. The Fed has done a lot. They've said they've actually been on a record pace. How concerned are you that it may go too far?
Well, I'm far more concerned about that than the other. I think the idea that they would keep raising rates because too many people have jobs is absurd. It's not only bad monetary policy, it's immoral economics. Jobs do not create inflation, Charles. People having jobs produces goods and services. It adds to supply and it brings down inflation. And your point that the rate of growth of wages has slowed, that's not only not good for lower income workers, but it's the exact opposite of what these Phillips curvers constantly predict. There has been no wage price spiral. And in fact, if you take out the lag in shelter inflation, they have about a 2.5% inflation rate right now. So I just don't believe that the Fed is keeping up with the times. And I think they are going to do exactly what you said, tighten too far and end up hurting ongoing CapEx and business investment.
So Rebecca, with that in mind, I mean, they've got 500 PhDs over there. It's golly. Maybe they don't go out and get out of the building much, but you know, they talk all the time. There's an army of them always talking, and they try to jawbone the market. That's fine. You can consider that a tool. But I feel like this Fed, the Powell Fed, has blew it on inflation, and I think they're trying too hard, and they're going to blow it again this time as well.
You know, Charles, the thing is that you can have as many PhDs in the world. You know, Keynesian theory has really never been completely proven, as MMT has never blown up. We've never had MMT to this level for this extended period of time to see what the actual results and repercussions are. So I think we're starting to finally feel the effects of too much of a debt burden, too many things going on at once, too much, just globally, everything that's happening, Charles. We can't stimulate, you know, through coronavirus and recapitalize investment banks in 2019 and stimulate coronavirus and have $8.6 trillion on a Fed balance sheet and think that we can keep fixing this problem by going back, pausing, pivoting, and doing that again. There has to be a reconciliation moment where this country figures out how we're going to actually pay our bills on an ongoing basis without debt barring against the whole world.
I'm sure this is not what they had in mind in 1913 when they formed the Fed. But, David, though, through it all, the markets hung in there pretty good, though.
Yeah, markets always trade in the long term around earnings, and they have to look through a lot of noise along the way. They have to look through the noise of debt ceiling discussions that are dumbfounding and how stupid they are. And they have to look through a lot of other volatility because the news cycle will always have different things. But, you know, Charles, the issue Rebecca brought up, I believe is the important one, and we have a precedent for, and that's Japan. When you get too much monetary policy, too much fiscal policy trying to fix things, it ultimately leads to downward pressure on growth. That can last for decades, not months. So for everyone who's hand-wringing over this period of inflation, which came from a lot of different policy errors, I think you're looking at decades of deflationary pressures because ultimately we have too much government trying to do too many things. That indebtedness is the problem. And unlike the financial crisis in 2008, which was households that were over-levered, this is governments that are over-levered. And it's a totally different animal. Japan is really the story I think people need to worry about.
Yeah, that's a great one to study. Rebecca, David, thank you both very, very much. Appreciate it.
Thank you.
All right, folks.